Welcome to the Financial Technology Report, a leading information source on financial technology companies and solutions. In this episode, we speak with Graham McClelland, CEO of Gen-H, a fintech mortgage lender working to expand access to homeownership in the UK. Gen-H focuses on buyers whose situations require more nuanced evaluation, including blended income, contract-based work, and small business ownership, and has built its platform to assess these cases with greater precision. The company also offers deposit and affordability support designed to help customers reach homes that fit their circumstances. Graham joined Gen-H after senior roles at Merrill Lynch, Goldman Sachs, and Morgan Stanley. Today, he leads the company's scale-up efforts, capital strategy, and the continued development of its lending model. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow. Graham, great to see you. Thanks for taking the time.
My pleasure. Thanks for taking the time to speak to me.
So from Wall Street to fintech mortgages, and I see you were started off at Merrill Lynch.
Yes, feels like a lifetime ago, but yes, back in the day.
Yeah, I think I was there maybe around the same time. I was in the private equity directs group.
Oh, okay.
Yeah, so I think you were probably doing more public financings.
Yes, I sat within the broader equity capital markets.
Great. And then you went through, was it Goldman and then Morgan Stanley?
Yes, most of my career at Goldman, but yeah, most recently Morgan Stanley, although again, that feels like a long time ago, different life.
And you were at Morgan Stanley and you decided, I'd like to make a change. And so you went to go work for Gen-H.
Yes, I mean, without going into sort of the details around the decision and the choices, I thought, I think, call it a midlife crisis, I don't know, but at that point where you sort of sitting there thinking, what, is this what I want to do for the rest of my days? I'd got to a relatively senior spot in investment banking. Maybe that was as high as it was going to go. But I sort of had that moment where you're looking forward to the next 2 years and looking back at the last 2 years. And I think for the first time in my career, wherever I looked in investment banking, they looked kind of the same. Mm-hmm. And I thought, I felt a bit young to be in that position. And so I thought, let's go and find a challenge. And I looked at a few different things, thought about a lot, but ultimately I met Will, who founded this business. And I guess we kind of clicked the combination of the problem that Gen-H was founded to try to help to solve, the vision that he and the team had for the business, and the part that I thought I could play in delivering some of that change and that growth. And in hindsight, joining a zero revenue, freshly Series A funded business was perhaps a bit sort of sane thing to do, but it's been a tremendous amount of fun, a lot of hard work. But I think feel like we're in a really good position, and ultimately we've done a lot of good, the people that we've helped into homes over the last few years.
We've had several folks on this podcast and our other podcasts who are former investment bankers that then went into corporate, or I'd say small, medium-sized or growth stage companies. And frequently they've done well. I think kind of like what you learn in investment banking is this hyper attention to detail and being analytical about what you're doing. The operational part, however, can escape some people.
Yes. We've hired some ex-investment bankers, not many, and also lots of people from big commercial banking and sort of consumer banking firms. And what I think is quite good about those profiles, you tend to have, smart, driven, motivated people. But what makes a difference, I think, is twofold. One is those that have the curiosity, and it really depends who you hire. There's plenty of people that are in those environments that are quite good at turning the wheels, making the machine work, and they're probably better at than I ever could be. But that's a very different skill set to trying to look at problems, trying to solve them, and trying to be creative in how you're thinking about that. And I think aligned to that, or sort of parallel to that, is that ability to deal with ambiguity. I was lucky to doing a bit of investment banking where every client challenge was different. Every opportunity looked a little bit different to the last one. So you had to be adept at, spinning a lot of plates, but also trying to think about different ways of solving unique problems. And then you take them to your risk colleagues and they might say something different. And then you've got to pivot over here, which is a really big part of it. And then I think the second one is exactly as you say, it is that operational experience. And can you transition, when you go 10-pin bowling as a child and they put their buffers down the side so you can't go off into the gully. Investment banking is a bit like that. It doesn't mean you're going to get a strike, but it means it's unlikely the ball is going to drop to zero because there are controls and things in place. And you definitely don't have that in a startup, which I generally loved and enjoyed. That I haven't got it right. We all make mistakes every day, but being able to go there and actually turn the wheels, change things, push the buttons and make a difference. When you come out of the sort of the safety first environment, not everybody has that. You definitely see that. But that's not just investment bankers. The other thing we see a lot, and we don't do it so much anymore, is when you hire people that might have you on paper, oh my goodness, they've done this 3 times over at this institution, that institution, and that institution. But you find quite quickly that if they're senior, they've actually done the thing for quite a long time, and they're very reliant on the people that sit below them to do that. So when you're hiring, trying to find the people, there's nobody ever in the history of interview go, I don't like to pull up my sleeves and get stuck in, right? Everybody will pull up their sleeves and get stuck in when asked. But trying to find the ways to test to make sure that people are actually, when they're in the weeds, they're ready to help you pull them up.
To that point, I was talking to another CEO, and he said when they look to hire, what they do, if someone's reached that senior position, they like that person, but they have to be clear, can you flex down to do the dirty work? And that person has to say, yes, I'm willing to go into the weeds again, and then gradually over time rise back to kind of that senior level.
That's it.
Let's talk about Gen H. We've had Habito on. Do you guys compete with them?
No, so they are effectively, a client of ours, customer of ours. So,
perfect.
So, back in a few years now, they were doing some lending, but their model is to go and find ultimately our end customers and provide advice on their mortgage journey. Which mortgage provider should they go with? What is the right type of mortgage for that customer? And then they will go and speak to the mortgage providers and, effectively matchmake between the two of them. So they're the intermediary. So we are effectively a B2B2C company, and they are the B2C bit. Broadly speaking, they're one of our 3 sets of customers. So we work closely with Habito. We like them a lot. They've done a really good job over the last 2 to 3 years, and a key customer of ours.
Awesome. So let's go into detail about Gen H and what it does.
Yeah. So in a nutshell, it's really straightforward. We are an owner-occupier mortgage lender. So we lend people money to buy the house that they then want to live in. And that remotely does us justice as to why we're here, right? Ultimately, I was looking the other day, there's been 120 different mortgage lenders in the UK. Does the UK need another mortgage lender? Yeah, on the surface, no, but you scratch even slightly on that surface and you can absolutely see the need. So the reason we exist is much like the rest of the developed world. We have a bit of a housing crisis here in the UK, and by which I mean we're not building enough of the right houses in the right places, and housing is increasingly unaffordable for those aged 40 and below, and obviously some above that age as well. But there's a real steep decline in home ownership below that sort of millennial and below wave. It's finding it increasingly hard to get on the property ladder. Part of that is external cost of living pressures. Said before, we're not building enough of the right houses in the right places, so lack of supply obviously puts pressure on demand. But acidification of property, right? You go back 30 years, people would buy a property to live in it, and you'd have some very specialist people that might be landlords, but in general, it was very unlikely that your neighbor or your neighbor's neighbor was a landlord. We've gone through a period in the last, it's not happening at the same level as it was 5 years ago, but we've had a 15, 20-year period where it's quite normal for people to own multiple properties and rent them out. Obviously, that's then taking away from the supply of people who own them. And so we've gone and said, well, what can we do? If you want to do something to make a difference, and that's legitimately where the business started. It didn't start because we wanted to build a mortgage lender or we saw an opportunity to make some money, because it's really hard to make money in mortgages as a new entrant. It is, well, actually, if you're going to make a difference to a housing crisis, which is a huge societal issue, follow the money. And so if you could come in and look at mortgage lending and think about what you can do, broadly speaking, 70, 80% of the owner-occupier mortgages in the UK are taken out by people who are employed. They're borrowing sensible amounts versus their income versus their trajectory. And as long as they're working one job, employed, full-time, part-time, together, as a couple or individually, actually getting a mortgage in the UK is not that bad. Maybe you want to borrow a little bit more, maybe you'd like a slightly nicer, bigger house. That the system works, and it works quite well. The big banks do a reasonable job. But you step outside of that bubble, and admittedly that's still is the majority of people. There's a real lack of proposition availability. So we really focus on 2 things. One is, how do you responsibly lend more money to people so they can get on the ladder or get, instead of buying a studio flat, they can buy a 1-bed or a 2-bedroom flat. Something that's more suitable for them and where they want to live and the community they want to be part of. And we do a lot of that through family support, for example, bringing parents onto a mortgage so they don't own the property, but they're there to act as backup for their children who want to own a property. So, thinking about how you can use that sort of bank of mum and dad responsibly to allow people to borrow a little bit more than they would otherwise be able to do. We've got a similar product that we've developed with one of the UK's leading house builders in Persimmon to help with deposit, which then helps with affordability. So it's all about dealing with that challenge where people go, well, the bank will lend me a mortgage, which is £1,500 a month, but I've been paying £2,000 a month of rent for 2 years. Why can't I afford something bigger? So how do you do that? And a lot of that's to do with regulatory pressures, stress testing, things that are there for legitimate reasons, but are holding people back. So how do you help to overcome some of those barriers? And then the other big chunk that we deal with is complexity. So again, as I said before, if you're employed, the high street works, Main Street, High Street works really well for you. The second you look a little bit different, it gets more challenging. And so what do I mean by that? I mean people who are, they're not on full-time permanent contracts, they're contractors, fixed-term contracts. They might be on a 0 hours contract. So they've got no minimum number of hours they get every week, but they've got a track record of working 35 hours a week, for example. We do quite a lot where people work 3 days a week employed and do 2 days a week self-employed, side hustle. So again, the bank can lend against that 3 days really well, but looking at that customer holistically, they're not set up to be able to deal with it. And then another big thing for us is sort of micro SMEs. So people who own businesses of like 1 to 5 people or work for a business of 1 to 5 people. Again, stuff that the Main Street lenders really struggle to process and understand. Because we built our own tech stack from A to Z, we're able to process those cases much more efficiently, I would argue, than anybody else in the UK, which allows us to underwrite them commercially and offer a product where others aren't. So we are genuinely creating incremental homeowners.
Fantastic. As you were kind of describing this, like the way you go about your maybe decisioning, your credit decisioning, the tough part may be that you may not have enough historical data on these types of situations where people are working self-employed or SME or some combination, and then they go to apply. You may not have the thousands of instances of these scenarios and knowing that the default rate is X% on those. I mean, if that is the case, how do you then come up with your formula?
That's a really good question. And I would sort of split it into two pieces. So you've got what is the data on that individual in terms of their credit performance and their track record and how do they behave? What have they done elsewhere? And then there is what is the track record of a cohort of people who look like this and their ability to pay. So on the first piece, actually, we don't do anything particularly different or sophisticated. What we do is we credit score them, we look at bureau data, we look at past performance, have they missed payments, etc. We're not doing anything that is materially different to what anybody else can do. And we're not taking a leap of faith in any way, shape or form with that group of people. Now, there's a load of cool stuff we would like to do and like to look at in time, and we probably will. The challenge there is capital. Getting the capital to agree with the fact that you might say, well, look, traditionally, these people don't look like the ones you would lend to, but we're confident that they're money good. That's a challenge with the capital. So I think we just need a bit more scale and confidence and ability to tell capital that actually, we're right, come with us on that journey. Mm-hmm. The second piece is then looking at those actual cases and putting them in context of how others like that have performed. And I think really there's two bits to that. So one is, so I call it risk appetite or philosophy, is that we believe quite strongly that people who are buying a house to live in it, want to live in it, and are very much financially tied to making it work. So people want to pay their mortgage. If it's their house and they really are living in it, even if they're borrowing a relatively high loan to value, there's still a huge amount of skin in the game in terms of that's where they live, that's where they're building their roots, the legal costs, the tax costs, the moving costs, the furniture costs. You're very much invested. So if people are making this decision to buy a house, they fully intend to pay the mortgage. And I think that's really important. That's how we start from a mentality point of view. And I don't think I'm sure if you ask them that directly, they say, oh, yes, of course we think like that. But I think if you see the way they behave, that's not necessarily true. And then the second piece is sort of being human at scale. So we're trying to make human decisions based on the specific facts and circumstances of an individual case. And this is where I think we really diverge from the majority of other lending that happens for mortgages in the UK, and that they are very much built around we looked at all these cohorts, this is what the system says yes to, and everything else is a no. And they don't look, because if you're using historical platforms, historical technology, it's expensive and difficult to do that consistently. But because we've got our own tech, we built everything in the last 3, 4, 5 years, it's very much built from first principle with these types of customers in mind. We are able to underwrite them significantly more efficiently while retaining that human element. And then when you start to layer in that powerful AI agents that we're building and deploying, you can then supercharge their ability to do that, both in terms of consistency of outcome and, volume that you can do per underwriter, but while retaining that human feel. So it's, the reason we get comfortable, the reason we've not lost a penny of anybody's money, we have minuscule amounts of mispayments and arrears in our business. And the reason is because we're making human decisions. We're looking at an individual specific facts and circumstances, not what a cohort of people that may or may not look like that person smashed together does. We're looking at that individual, and it makes a huge difference.
Give us a sense for the scale of the business currently.
So we are very much on the smaller end of things. So we'll offer on getting up to $1 billion going through the business this year. We've been around for 5 years. So 5 years ago, that was zero. We've grown up there. That's not as fast as we'd like to have grown. And, hopefully we can carry that momentum. So we're offering $1 billion this year. We want £1 billion plus next year if we can, and then keep that level of momentum growing. I think we've learned a lot around, it's not just the number of loans you make. It's, what are the returns you're delivering to your capital providers, your funding partners, what makes sense for them, what is actually delivering real equity value for us, for our shareholders, real value for our capital providers, trying to work out that, really crudely, anyone can sell a £10 note for £5. That doesn't have a lot of value. So as much as we want our prices to be as low as possible for our customers, chasing the cheapest possible mortgage isn't really creating value. What is creating value is finding situations where there are people who are locked out of the housing market, and then finding ways to give them access, and that delivers an appropriate return for our various stakeholders. And then it comes down to, you mentioned Habito earlier, partners like Habito, and how do we get them to tell the story? Our challenge is when a customer comes into Habito and one of its advisors, that they look at a situation and go, oh, we can't help you, to change that mindset and go, actually, there's a set of products over here that have got you in mind. And whereas you may have had to wait 2-3 years, if Gen H wasn't around, you can now get onto the ladder. So we are at the beginning. In terms of startup mortgage lenders, we've done well. And I think we probably outperform our peers, but we've got a long way to go.
So it sounds like the way your machine works is good. You've built it well. It's working. The capital providers are there. Obviously, you have to present compelling cases, portfolios, et cetera. Seems like the constraint is on just penetrating the market, getting the word out more. How big is this market, this set of folks that lie outside of mainstream mortgage financing?
It's billions, if not trillions. It's a very flippant answer, but it is absolutely huge. You quite often get the challenge of, well, if you're creating these products, are you not just increasing demand, which just drives the price, which makes the problem in the long term worse? To which my response is always, we do not create the demand. This is not like you're creating a new iPhone or you're creating a product and like creating desire and need to own, and actually you don't. People have a need for housing. That need for housing doesn't belong to the mortgage lender. It doesn't belong to the landlord. It's effectively a basic human right, a right to shelter in a really simplistic terms. And so what we're trying to do is turn that balance such that those who want to own a house to live in it have a fair shot versus a buy to let investor or somebody trying to build a property, a portfolio, or an overseas investor or a second homeowner. How do you turn the balance so that actually demand is going to people who want to live in it in their community? And homeownership rates in the UK are, much like the US, are declining, and they're declining rapidly. And it's just a huge looming problem for the younger generation. So we do need to fix it. And so that's a huge opportunity. We're not going to solve it on our own. What we really need is to see the regulatory partners come along with us, the bigger lenders, the bigger balance sheet institutions, also thinking about this, ideally working all of those, the powers that be, the party and government at that time, thinking about these issues, ideally seeking our input in the things that we think we could help to unlock that. It's a truly huge opportunity. And as you rightly point out, the challenge is getting that message out there so that people understand they do have options. And hopefully over time we iterate, we increase the range of options that are available so we can help more and more people into home ownership.
Wonderful. Well, Graham, we're just about up on time. I really appreciate you joining us today. It's been a great conversation.
Pleasure. Thanks for taking the time.